Hello everyone and welcome back to Southern Wealth. I hope you guys are doing very well. Do you enjoy the content? Please consider dropping that like and subscribe. It greatly helps the channel, so thank you very much. So as I've mentioned, as of Friday, I'll be traveling over the evening, and then after Saturday, I will be officially on holiday, and I will be also in a different country for about a month. So I do expect a bit of a different setup going forward. However, I will try to record and upload as many videos as I can. But without further ado, let's go straight to the analysis today. So once again, the inflation numbers came out. PPI came better than expected, so that is for the companies. Usually PPI tends to precede the CPI, meaning if PPI keeps on dropping consistently, CPI eventually has the tendency to follow. CPI came as expected. I was hoping that it would come a little bit softer, but it came as expected. Most importantly, it didn't come worse than expected. And there's a bit of mixed reaction in the markets. The S&P and Dow Jones are up. Nasdaq and Russell are down. Gold is down. Bitcoin has been in this sideways movement between 57 and 62K that I've mentioned last week, that we should be around those levels. So far has happened exactly as expected. Now, TLT, the bonds are going up in value, which is good. As I've mentioned, the bond market dictates the pace for the rest of the markets. It doesn't necessarily need to go up, but it needs to be fairly stable for the rest of the move to follow. Now, what I wanted to discuss here, and I think this is an important subject to discuss, even if the inflation came worse than expected, the market would obviously sell off and probably sell off aggressively. You see, but we know something that the market participants have yet to price in. In my opinion, and this is just my opinion, the rate cuts are inevitable. That means if the inflation numbers are bad, or if the job numbers are good, and the market sells off, I think that the market is not pricing the fact that the interest rates will come down regardless of what type of data will come up. And the reason for it is very simple. It is mathematical. There is too much debt for us to have high interest rates. So in 2024, 76% of the entire income tax revenue of US citizens will be used to pay interest on the debt. That is my point. The only way you could have high interest rates for a long time is if the Treasury would be helping out and basically having surplus in terms of budget to repay the debt. But because they are actually approaching $2 trillion of deficit just this year, and we're not even in September, we still have a full month and a half of the third quarter, and we are already close to $2 trillion. Probably we're going to finish up the year around 3 trillion by, taking into account also the approval that the Treasury already got to spend. That means that the debt is growing $2 to $3 trillion per year on quote unquote good years, which means that the debt is compounding, and you cannot have high interest rates with these levels of debt. If you don't believe me, ask Japan and see what happened to their stock market by a measly 50 basis points or 0.5% increase. We are in the same path. Japan is just ahead of us. Why? Because they started this game of money printing and low interest rates and propping up markets in the 90s, where we only started it in the 2010s. So we are 20 years away. So this is why when people say that it's imminent, the destruction of this and the other, I say be careful with those kind of comments, because Japan has been doing it 20 years before we did it, and they're still going with that, and without major cataclysmic events like all these people predict. By the way, I saw a comment on Peter Schiff's Twitter, and this is true, I completely forgot about this. I don't remember who dropped this tweet, but it said, in August of 2022, let me read it here, in August of 2022, Peter Schiff said in his podcast that inflation would never go to the 2% handle in his lifetime, even by government measures. So today we saw 2.9%. So this prediction lasted 2 years before it was utterly wrong. Of course, Peter Schiff will not address this. He will just pretend that nothing happens. He's already saying that the Fed will cut rates and inflation will go through the roof, despite the fact that all the other countries have cut rates already ahead of the US, and even the UK has cut rates twice, and they are reporting lower inflation than expected. Guess who predicted that? Me on this channel, and everybody knows. I said, as soon as they start cutting rates, you will see inflation keep on going down, and people will be utterly surprised. How is this possible? By the way, Dutch inflation also came out. The ECB also cut rates, and the Dutch inflation is also better than expected. And the majority of the countries in Europe have had inflation readings better than expected after the rate cuts. What a surprise. Oh, by the way, do you know who also had this thing? Yeah, China. China started cutting rates in June of 2023. Guess what they're fighting? Deflation. What? But I thought Peter Schiff told me that as soon as they cut rates, inflation is going to explode. Yeah, no. What is my source for my opinion? I don't know. The last 30 years in Japan, the last 15 years in Europe and the US, and the last, 8-9 years in China. That's it. So my only evidence is several decades of information spread across different parts of the globe. But I mean, I can always follow his track record. I just checked his gold fund, and his gold fund is basically flat since inception of 2013, not even inflation adjusted, just nominally, just versus the day that the fund started to now, it's pretty much flat. So congratulations for the people who bought his funds. They must have done incredibly well, and they get the benefit of paying high management fees per year, which means if you actually take into account the fees, the dividends, but also the short-term capital gain taxes, people are not actually flat. They are deeply in the red in his funds. But that's a story for a different video. And so now you are in possession of a very important information, which is liquidity needs to be added into the system. Rates need to be pushed down. Why? Because there's no other way to deal with these levels of debt. And when people expect inflation to go through the roof, they will be very surprised that inflation will keep on proceeding with its declining trajectory. And here is the key. The market will figure out this very soon because they seem to have forgotten what happened in the past. They actually believe the Fed in the sense that if for some reason inflation numbers come higher, the Fed will stop rate cuts. No, because the Fed also ran the same numbers that I did, and they will find out that huge amounts of taxpayers' money, and when I say taxpayers, I'm counting corporates as well, will be used to pay simply interest on the debt. So forget Medicare, Medicaid, Social Security, pensions, army, and the like, just to pay interest on the debt. So because they know exactly that that's going to happen, they will cut rates down. Now, the dollar will probably tank when they start cutting rates more aggressively. You see, the dollar is within this system of money printing and low interest rates is designed to be somewhere between 93 and 110. In extreme moments of easiness and liquidity, it can drop, 88, 86, like we've seen in 2020 or 2021. And in moments of high shortage of liquidity, it can go to 115, 118, 120, like we saw in 2022. So there's nothing special about this. It's been the dollar versus the other currencies is designed in this world of central bank manipulation to be within these parameters. So I still don't understand why people get so shocked about this. But basically, for people who've been trading the Dixie, and as you guys know, I'm not a trader, but I cannot tell you what to do or not. It seems to me that one of the things, the easiest things to do is short in the high 110s and buy on the low 90s. But once again, I'm not here to advocate to do it. What I'm saying is, if you actually pay attention to the development of the markets over the years, you'll see that the dollar index is pretty much sandwiched between those levels. Now, when it comes to crypto, we are in a week of consolidation. We are still at very high levels, way above the levels that we dropped last week. As I've mentioned, my expectation is that, and based on previous cycles, is that the second week of August, we start to see some more consistent movement to the upside. Now, I need to be very clear because I already know how these things go. What I'm saying is, after the second half of August, meaning next week or so, we should start moving more consistently towards upper numbers. Does this mean that Ethereum will go from 2,600 to 5,000 next week? No, I didn't say that. Can it happen? Sure, very unlikely, but it can. But no, but what I'm saying is, I expect Ethereum to start moving into the 2,800, 2,900, and then eventually to the 3,000, 3,200, around those levels. And then by the second half of September, I do expect Bitcoin to be above 80K and Ethereum to be above 4,000. That is my expectation. I'm a bit undecided on that one, because I can also see it happen on the second half of November. So I'm a bit torn between second half of September and second half of November. Both are good options. I don't think it's going to be October. But I'll keep it at second half of September. And let's do that like this. If I happen to be right, I will take soft credit. Okay, I will say, look, I was actually, on my gamble, I got lucky. If I get it wrong, I'll say, look, on my gamble, I got it wrong. Okay, so I'll keep it true and real. So to me, what I'm looking at, my personal humble opinion, is that liquidity is coming into the system regardless of what the data says, and rate cuts are coming regardless of what the data says, and the market is unaware of this at this moment, or it seems to be unaware of this moment, which is good. That offers the opportunity to position properly before the rest of the market starts to figure out that regardless of what the Fed advocates, they will be cutting rates regardless of what the data says. Although I do expect the data to keep on following this trajectory, I wouldn't be surprised if the job reports kind of go down a little bit or stabilize. The job reports, for those of you who've been following this channel, have been weak for 18 months. However, very importantly, and we discussed this ad nauseum here, we know that the job report is garbage. Part-time jobs being created, full-time jobs being destroyed, government jobs being created, and people getting second and third jobs. This has been happening over the last 18 months. The thing is, the markets trade the title, the headlines. Oh, and by the way, of course, we just revised a bunch of data going back, where actually all the jobs we created, more than half of them got completely slashed in the revisions. But once again, then we know that the job market is weak. The numbers or the headlines are trying to say, or were trying to say up until very recently, that the job reports were strong. The market reacts to what? To the headlines. That's why they always lie on the first report, and then 1 month goes forward, they come up with a report and they revise the previous report, because they know the market doesn't care about the revision of the other report. They care about the headlines. That's all they care about. And the problem with economists, and this is why they never make any money in the markets, is because they are aware of all these little details in the economy. They stop paying attention to the forest and only looking at several different trees, and they give themselves importance to a report, and they don't think in terms of how the market will react, but in terms of, oh, this is what I know. And this is where the saying comes the market can remain irrational longer than you can remain solvent. This is linked to the fact that you are looking at certain data that only you care about, or very few people care about. You understand the problem, the underlying problem, but you are not thinking how the market participants are looking at the information. So basically, if I know that the job market is weak, and I just gave you the reasons why, but I know that the market participants will look at the headlines, then you need to position based on, okay, I know that this will happen sometime in the future. So basically, if the stocks are selling, so in my view, this is what I've done is, okay, if the risk assets are being sold off because the job reports are strong and I know they are weak, I know that eventually one of these job reports will be very weak and the money printing will eventually come. So I position by buying the dip in my case. Now, I'm not trying to advise you or anything. What I'm trying to tell you, what I'm trying to show you is it's important to understand where the market is going based on the strong underlying trends, and not, oh, the CPI came out, but we didn't beat the numbers, so maybe the Fed will not cut rates anymore. Or, oh, the inflation came 0.1% worse, so the Fed will no longer cut rates. No, you know the Fed needs to cut rates, and you know that the Treasury already has approval for $270 billion up to $1 trillion in liquidity to be injected to prop up the markets and the economy in Q4 of this year, in the last desperation for Kamala to be re-elected or elected for the first time, since she's the first candidate for president without one single vote. I think it's the first one in history, because in 2020 she had 0 votes from her own party, and now she was not voted by anybody. So I guess that it is the first time in history that we are seeing a presidential candidate accusing another of being a threat to democracy, while the person that is making the accusation is in the position to be elected without ever getting one single vote. Funny how these ironic things work. But with that, guys, thank you very much for your support. I'll catch you in the next one. Don't forget, like and subscribe. Watch the forest and never the trees. Thank you very much. I'll catch you in the next one.